Hi everyone, welcome to today's video. In this video, we will get to know what are underlines and what are derivatives. Moreover, we'll be talking about a special type of derivative called options. Now, first understand what are underlines and derivatives and what are their differences. For an example, you can have an apple which you can say as an underline. From that apple, you can derive apple juice, which can be called as the derivative. So, for example, underlines that can be an apple and derivative is the juice that is derived from apple. Now, in the stock market, a particular stock like HDFC Securities or Reliance Industries stock is the underlying, and the derivative derived out of this stock is called as the derivative, such as call option or put option. Underlying will be a particular stock like HDFC stock, and derivative would be an option that can be either call or put. As you can see, options are of two types, call option or the put option. You can be either a buyer or a seller of the option, and based on your choice, the profit and loss will vary. Now, before going into depth, first understand what is a call option. For that, we will consider an example of a man buying a land from another one. Let's say person A wants to buy a land from person B. Now, the person A has the news that after 6 months there will be a highway project will be sanctioned near to this land. Now, if this news is true, the value of land is surely going up. Now, there is a possibility that this news is just a rumor, which can result in two possibilities. That is, the value of land would go down or it will remain same. Now, in this particular situation, person A is in dilemma whether he should buy or not. In this particular situation, person A is in dilemma whether he should buy the land or not. Hence, person A comes up with a special structured arrangement for person B. The details of that particular arrangement are: number one, there would be an upfront fee of, let's say, rupees 5 lakhs that person A would give to person B. Against this upfront fee, person B would sell the land to person A after 6 months. Third one is the price of the land would be rupees 50 lakh itself. Even after 6 months while selling, it will be set to 50 lakh rupees. As person A has given the upfront fee, only he has the right to call off this agreement if he want to at the end of 6 months. And if person A call off this agreement at the end of 6 months, person B would keep the whole amount of the upfront fee. Now after 6 months, there can be three possibilities. Number one, the value of land goes up. Let's say 1 crore rupees. Number two, the value of land keeps constant from 50 lakh to 50 lakh. And number three, the value of land goes down from 50 lakhs to, let's say, 30 lakhs. Now let's look at all these possibilities one by one. Now in this particular situation, if the value of land goes up to, let's say, 1 crore rupees, the person A would buy the land for rupees 50 lakhs as mentioned in the agreement. But the person A has also paid an upfront fee of rupees 5 lakhs to person B. Moreover, the value of land would be 1 crore rupees. This will bring rupees 45 lakhs as net profit for person A. Now for person B, now this profit for person A would be a loss for person B, as the person B has sold 1 crore worth of land to person B for 50 lakhs but has kept the upfront fee of 5 lakhs. Now let's look at the second possibility, in which the value of land remains constant from 50 lakh rupees to 50 lakh rupees after 6 months. In this particular situation, person A will buy land as he is obliged to buy the land from person B at the preset requirement of 50 lakh rupees. But in this particular situation, person A has to pay the upfront fee of rupees 5 lakh to person B. And in this case, person A would be in loss of rupees 5 lakhs, which is the upfront fee he has to pay to person B. And the exact same amount would be the profit for person B. Now let's have a look at the third possibility in which the value of land goes down. Let's say 30 lakh rupees. In this particular situation, person A has to buy the land as he is obliged to buy the land at the given price, that is 50 lakh. But the market value of the land is now 30 lakhs. Provided this information, person A has lost 25 lakhs. In this particular situation, person A had 33.33% probability to make a profit while person B had 66.66% to make profit. The question here is, why would person A make this deal when he knew that he had such a low probability of making a profit? As from the above transactions, we have seen that person A would have to pay only the upfront fee, that is rupees 5 lakh rupees. Hence, person A can make a maximum loss of rupees 5 lakh. So as discussed, if the value of land goes beyond 50 lakh rupees, that is 30 lakh rupees, person A can easily call off the agreement, making its maximum loss of only 5 lakh rupees, which is the upfront fee he had paid. Now in this particular example that we discussed, the land is the underlying and the agreement is the derivative. And this particular type of agreement is known as the options agreement. One thing to remember in the options agreement is that the buyer always has the right and the seller always has an obligation. Now in the terms of stock market or in the financial jargon, let's take another example of a particular stock. Let's say ABC stock. Now let's take an example of an ABC stock which is currently trading at rupees 100 per share. Now you are given the right to buy that particular share at rupees 120 after 2 months. Now same as the example that we discussed, there can be three possibilities. Either the share price can go up, down or can remain the same. And for buying this agreement, you paid an upfront fee of let's say rupees 5. Now in this particular example, ABC stock is an underlying 2 months, that is the date after which you have to buy that particular stock is called the expiry. The price which is set that you have to buy that share after 2 months is called the strike price, and the upfront fee that you paid is known as the premium. And the one who regulates all those things is the National Stock Exchange. That's all for today. In this video, we got to know about the basics of call options.